This conference will now be recorded.
I see. So it's 70% occupancy in flights. Wow.
70-80%, yeah.
Nice. But Sandeep, the number of flights are restricted to probably 1/10 or
50%.
50% of
No.
the
Now
total
it is 50.
capacity.
Now it is
50%.
50%. International flights are not there. They are just those,
In the
This conference
mainstream
will now be recorded.
consciousness of Indian people or Indian industry, it's always seen as, MSME is someone on the fringes of the economy, which is really not the case if you look at the math.
yeah.
And Sanjeev will, when he's introducing you, he will talk about the role of MSMEs in Indian economy and how. All the
This
best, Megha.
conference will now be recorded.
Thank you, sir. Thank you so much. Very good afternoon, ladies and gentlemen. On behalf of our Secretary General, Dr. G.P. Agarwal, and Dr. Sanjeev Lack, Executive Secretary, WASME, I, Megha Chadda, heartily welcome Mr. Sandeep Daga, Founder and Managing Director, Nine Rivers Capital, and Mr. Prabir Roy, Senior Advisor, WASME, for accepting our invitation for the webinar. It's my privilege to welcome all the dignitaries who have taken out their valuable time to participate in this webinar. Let me brief about WASME, a global organization having member representatives in more than 100 countries, spearheading the cause and development and promotion of SMEs worldwide through policy advocacy, information dissemination, conferences, seminars, events, trainings, publication, network linkages, and many more since 1980. WASME has the consultative and observer status of United Nations. Let me give my thought on MSME sector. Backbone of the Indian economy, an estimated 6.33 crore unincorporated MSMEs engaged in non-agricultural economic activities, employing 12 crore persons across the country, 99% industry share, contributing 30% to Indian GDP, generating 70 to 80% employment, contributing 45% to exports, micro more than 95% having turnover less than 5 crores. As you're aware of that COVID has disrupted life and business across globe, credit is the most important pillar of business. MSME have been struggling with working capital. One third of MSME have closed their shops in India. I'm not going in detail as we have esteemed panelists to discussion on this topic. Let me introduce Sandeep Daga sir. As the founder, Sandeep provides strategic leadership to the group and actively manage business as its CIO. He has more than 25 years of experience in public, private, and corporate finance. Prior to founding Nine River Capital, he has partnered at Frontline Ventures and India Centric PE, the PE fund advised by Frontline delivered top quartile returns over a 5+ year period. Career in venture capital provide equity investing with ICICI Ventures as head. B2B investments also been exposed to corporate finance with a leading NBFC and a business conglomerate in their career. Sandeep holds an MBA in finance from NMIMS and an engineering graduate in electronics. Sandeep Daga founder in conversation with Prabir Roy. Prabir Roy is a serial entrepreneur and now in co-founder Payment, a B2B fintech payment company and has Visa at one its investors. He has worked in government, public and MNC sector as vice president, CTO and CEO and Red Herring Asia Top 100 awards for promising tech startup companies. In addition, Probi sits on boards of several private, public and industry organizations like WASME. Handing over mic to Probi Roy, sir. Mr. Roy, please, I'm handing over mic to you. Thank you so much.
Hey, thanks, Megha. Warm welcome to all the participants today. Special thanks to Dr. Sanjeev Layak and Mr. Agarwal of WASME for continuing to go forward with this platform that we have thought of for MSME owners and managers. I think Megha has already introduced Sandeep, so I won't really spend too much of time on that. So Sandeep, let's jump right into it and tell me, in the August company of entrepreneurs that we have today as audience members, tell us your own journey as an entrepreneur, especially since you also were on top of your game as part of a very blue chip finance company in the corporate sector for many years before you all gave that up and started your own entrepreneurial journey in building your own portfolio management system company. So tell us a little bit of your journey.
At the outset, thank you, Dr. Layak, Megha, and Probi for the kind words. And it's really indeed an honor to be on this platform to share and having this opportunity to share my views with you. So, Prabir, I set up Nine Rivers Capital in the year 2008. However, even in my prior role as a partner at Frontline Ventures, being a partner in a PE firm is a semi-entrepreneurial role. You
Right.
have that, you have that leeway of taking certain decisions, and going wrong, and yet and yet coming back and then correcting those situations. So I think the seeds of entrepreneurship were sown while I was in Frontline, and then in the year 2008. I founded Nine Rivers Capital. Again, our focus initially was on private equity for SME companies. So we raised a private equity fund, and since 2012, or rather to the beginning of 2013, we've been focused on the small and mid caps in the public markets. So it's been the aspiration was actually to set up a very a credible independent institutional platform for invest for somebody who's dedicated to small and mid caps.
Right.
When we got into this business, there weren't dedicated platforms who were focused on small and mid caps, and all in other parts of the world, developed world, you have very dedicated small and mid cap asset managers. So we perhaps are amongst the foremost who decided to dedicate, and I think from a credibility standpoint, 8 years down the line, I can say that we have established that credibility. Of course, we have a long way to go. There is a huge headroom for us to grow, and I'm keeping my fingers crossed.
Yeah. So just to, I was before we got you on board, I was just looking at some numbers that which are available, and I think that your own entrepreneurial journey is one of excellence itself because I think your portfolio has returned 20-25% CAGR returns in a 5 to 7 year
Yes.
horizon, which is a very sustained and secular trajectory for this particular sector of small and mid cap. So any any strategy that you felt has worked for you so that you're today on the top of your game in the sense that I think you're one of the top 25% of PMS firms in the country who have returned maybe even 3-digit% return in the last, well, 6 months or 1 year. So any particular secret sauce that you have?
So I wish I had a secret sauce, but see, our tagline when we talk about ourselves, we say that it's the private equity approach to small and mid cap investing. So what we do here, and everything has to be measured from a long-term sense, because short-term often, you have yes, we did deliver nearly 100% in the last 6 months, but that does not mean that that needs to become the benchmark for returns. What we do here is we apply the rigor, the discipline, and that long-term approach of private equity investing at the time when we identify investment opportunities. When we stay invested, we closely monitor our investment opportunities from that in the same private equity style, and eventually we exit every opportunity. For us, exit is as much important as entry, and that I would say has been consistently deployed as a part of our strategy. Those principles are there from day one when we started till now, almost 8 years into the strategy. So I would say that that private equity bent and careers of or that I bring to the table, that has helped
Right.
in shaping up the strategy of the firm.
Yeah, very interesting. Actually, I would like to give you as much credit as possible, but everybody knows that small and mid caps have had a pretty decent run by themselves in the last decade. Except I
Right.
think just around COVID and around March this year, it was not looking good. And so, but you enjoyed that rising tides phenomena to some extent. I'm sure you capitalize on that. But going forward, Sandeep, now that the US elections have been called, there is a broad resurgence in large caps also in last month. Going forward, how do you see small and mid caps? Do you feel same sense of buoyancy as in the last few months and maybe last many years, or you tend to assume that there could be some rebalancing of your portfolio which might be required so that you do invest in some mature, stable, large cap guys as also blend your small and mid caps with the fast movers and decent and quick return companies.
Uh, Probir, okay, so last one decade would have seen at least three major down cycles for small
Okay.
caps and three
Right.
major up cycles. So it's not just
Okay.
COVID.
Okay.
In fact, the recent one, which was in 2018, that down cycle was also a very harsh down cycle in small caps. In
Right.
fact, in the calendar year 2018, every small cap manager in this country would have given negative returns. So, when you invest in small caps, first of all, you cannot look at short-term and immediate returns or shorter-term returns because
Right.
you can't predict those returns. They do happen, from time to time. You will have this phase of the market where markets will simply fly away, or your stocks will do very well. But that cannot be predicted, and
Right.
therefore, again, I want to emphasize that when you invest in small caps, have at least a 5 year view. And I want to caveat again that small caps. For any short-term investor is very, very risky. Even for a long-term investor, the risk of volatility and the risk of low liquidity that goes with small caps will always be there. But for a shorter-term investor, the unfortunately that a short-term investor may not even have an opportunity to take advantage of that volatile, because volatility also brings in times when some of the small caps are really available and are become screaming buys because they are fundamentally the companies which are strong, traded very, very attractive valuations, bargain valuations. But that all you can have as a portfolio strategy when you look at the long term. What we do to navigate the risk of okay, the markets have done very well, so should we be switching out of small caps to large caps? No, we don't do that because we are small cap
Right.
specialists. People give us
Oh,
money as their small cap allocation, so they don't expect us to invest in large caps. Their large cap allocations are through mutual funds or through some other manager they are managing. What we do is we basically have what we call as guardrail prices, where when the markets fly away and small cap seems to be well priced or fully priced, we start selling and generating cash and sitting in cash for a while. And we again wait for an
right.
opportune time or a new stock idea which is available at an extremely good, reasonable valuation. We will look at that stock to invest in. So that's our way to kind of navigate these market cycles, because we are driven by certain exit goals and certain entry price norms. Both these allow us from time to time to book profits and also enter this. So in that sense, relatively, I would say that we have a lesser correlation to the larger market as a strategy.
Right. So, as we go forward, are you still positive on the inflows into this segment on the back of the overall sentiment of momentum and growth post the India unlocking? or what Dr. Subbarao, a former governor of RBI, says on the mechanical rebound that the economy is going through? Or do you see that there will be some hiatus in the run-up of the mid and small cap segment going forward?
You will see there is always an element of mechanical rebound because of the we went into the world's most stringent lockdown was implemented in India.
Right.
Nowhere else in the world you had this kind of a stringent lockdown. So when the lockdown was opened up, obviously there will be certain amount of a pent up demand which will come up, and that will show up in the company numbers which we are seeing right now. A lot of companies have actually performed much better than the street's expectations, and that was on account of obviously good growth that they've seen on the top line, but also they implemented cost control measures which has also showed up the bottom line or reduced the losses as the case may be. Uh, but there is also the macro scenario which you have to factor in. What is the macro scenario? Macro scenario is that uh, globally, in whether it's the American boardrooms or whether it is in Japanese boardrooms or Australian boardrooms, today what is being China plus one is being discussed as a very important element of strategy going forward. People want to, it's not about not wanting to buy from China. China obviously will remain a source of a lot of goods to be sourced, but I also need one more credible source. When it could be India, it could be Vietnam, it could be Indonesia, but I need one more source. Now this is real. Why I am saying this, and this is very important message that I want to give to the MSME entrepreneurs who may be there today listening. I can tell you that the companies, multinational companies, will come to India, not from all the sectors, but many sectors. They especially engineered goods, chemicals, pharmaceuticals, a lot of some more of where there is a skill and a value addition. Any of those industries, India will see a lot of investments and multinationals coming into the country, and they will then obviously work with the Indian supply chain. They can't bring each of their supply chain partners over here. Even if they bring, those supply chain partners will require joint venture partners, or they may want to
Sure.
so there is this big opportunity, and that we are seeing happening when
Sure.
we talk to our investee companies and the companies that we are tracking. The number of inquiries from abroad have gone up. For example, there is an automotive components company which we have been talking to recently.
Yeah.
And already he's a OEM supplier to one of the large MNC companies in India. It's a four-wheeler company. So the guy says that now the number of inquiries that I'm getting from the
Nice.
same MNC company, their other offices, their
Sure.
other, that has gone up. So earlier, maybe, the sourcing that was happening from China today will happen from India to those subsidiaries of this MNC in other markets. So this is
Right.
already visible. And that's where I feel that the growth is real. It is with a lot of sectors. There are obviously certain sectors which are impacted, which will take a while to come out, which is travel, tourism, leisure, entertainment, restauranting. But there too, the models are obviously, newer models of delivery of leisure and entertainment, newer models of home delivery of from restaurants that has shot up. So India is very entrepreneurial. I'm actually quite but there has to obviously this is like a samudra manthan, where some people will have to obviously perish and take a rebirth.
Sure.
Some
Yeah.
companies or some businesses will have to perish and take a rebirth, while others will in the interim benefit at the cost of those who perish. So that's what is my sense here in terms of where the sector is headed, and I'm quite upbeat on the overall economic growth of India, including the MSMEs.
That's great. You actually went into my next question, and I like the way that you sounding upbeat and optimistic on the MSME sector, and it sort of melds with my own thinking that creative destruction will be taking place, that the old will give way to the new, and the new will take it to new heights, and as I call it, MSME 2.0. Now that we're discussing MSMEs, by and large, though some MSMEs are doing well, some will rebound, reset, reinvent themselves, pivot, some will die, new ones will take their place. The overall MSME sector has been in some distress, as you know. So,
Yes.
will this have some effect on people like you, on the choice of companies you undertake in the small and mid cap? Will it make you more wary? Will it make you more upbeat? Or will you be looking at everything through a very strong lens of financial numbers and not so much on growth prospects and growth potential?
So, actually, you are absolutely right, Probir. MSMEs at a very aggregate level are facing distress on account of debt on their books, and and also the credit availability to revive business or to assume further debt has gone down. Lenders are unwilling to do it, and that actually is something which is a fundamental challenge which policymakers and Indian economy will have to kind of, Indian economists and policymakers will have to think through, because we still have very high interest rates. We still ask for hard collaterals. So we are, we still ask for personal guarantees. So, and on the one hand, on the other hand, the resolution of NPAs don't happen in time. So it's a challenge which is beyond what I would like to opine on. But the policy is in the right direction to kind of get there. But we have a long distance to cover. What
Sure.
we do, actually, we are beneficiaries of this distress, honestly, because from when we looked at rolling out this PMS 8 years
Right.
ago, the fundamental, we basically looking at the past and studying the history, we realized that the key risk mitigating factors when we invest in SME companies, especially in the market cap, the fundamental risk mitigation is around two aspects or two pillars of risk mitigation, if I may say so. One is, don't buy fragile balance sheets. And that has remained, from day one when we started until today. All our investee companies, most of them are zero debt. Few of them who
Right.
have debt have minuscule debt. So, in the current situation, what is happening, Provir, and this is not just with our investee companies, I'm saying that this is a trend that well capitalized and under leveraged or zero leverage companies are going to benefit at the cost of lot of companies which are carrying debt, be it SMEs or otherwise, or companies or businesses from the unorganized sector, who anyway have more challenges that go beyond it. So that is what is happening, and that is leading to our companies. Generally, we have seen that have come up with a performance which is much better than our expectations. So obviously, somewhere the unorganized to organized, or the move from weaker balance sheets, the business moving from weaker balance sheets to stronger balance sheets is happening. If you give me a second, I would want at this is an opportunity
Please.
to share with you what goes into building a successful company,
Sure.
what we have over the years seen, and I've kind of captured those as attributes that go into building a good company, what we look for in our investing companies, but they also become attributes, and it could be very I think for the audience over here, especially those who are entrepreneurs, maybe there may be some snippets that they can carry home when they do their strategic
Sure.
planning.
So
So
please
maybe
go
if I
ahead. Yeah.
just,
Share with us.
yeah, I think somebody will have to make me the presenter, and then I can share.
I think Megha will make you the presenter.
Megha, yeah. In the meanwhile, while she does the
Yeah, we can see the slides, Sandeep. If you can put it full screen, that will be okay.
Please unmute.
We can see the screen, Sandeep.
No. I only wanted to make it full screen, but the GoToMeeting screen is at a place where I can't move the screen to toggle it anyway. So I can do it from here perhaps.
Yep, sounds good.
Okay. Can you see this?
Yep, very clearly. Very
Great.
clearly.
So what do we look for in our portfolio companies is the slide, and you know any business can grow when and can do well when you have certain macro tailwinds. So any entrepreneur should look at when either getting into a business or wanting to grow a business, that am I going to be a beneficiary of some macro tailwinds? These could be regulatory tailwinds, policy tailwinds, renewable power, or tomorrow a vehicle scrapping policy is coming, for example, it's just due any day now. So that's a tailwind available to the automotive industry. So one has to look at some macro tailwinds, because that will allow you to grow your business, and even you can afford to make a few mistakes because the macro tailwinds will carry you through. So it's, the demographic tailwinds are more to do with consumer behavior and consumption patterns. Think of it as go back about 10 years when India was always a two-wheeler leader, and you had these two-wheeler companies, but Eicher was reinventing itself 10 years, 12 years
Right.
ago. And as an entrepreneur, you at that point in time, Eicher was looking for dealerships. Eicher was building its, supply chain, manufacturing on the manufacturing side, supply chain partners, and those would have seen the trend of aspirational bikes, because India is becoming richer and the disposable income is growing. Had you seen that aspirational trend, and you would have latched onto the Eicher value
Stop.
chain early on, you would have made tons of money in business. Now those who bought the stock, or those who would have seen, so we see from a stock point of view, entrepreneurs see it from their business point of view, but both benefited immensely. So the macro tailwinds are very important. For instance, in the technology side today, we are seeing macro tailwind in the digital transformation area, where companies from India can serve the world in their digital transformation initiatives, and that kind of let's say the old world IT company, if it wants to reinvent itself, it can focus on digital transformations. We have seen some wonderful stocks that we invested in, and we have seen very good returns. Majesco being one of these companies which serves the insurance sector in the US, focused on digital transformation and just got bought out by a large PE fund in the US. The next thing that what we see is we want to see a solid business franchise. So typically the companies are leaders in their space. They would be it could be a niche, but within that it could be a leader. For example, you have pain balms as a category, and Amrutanjan being a leader. So it's a niche, but still leader in that space is something which we look for. We look for some innovation in the business. It could be tech innovation for tech companies, but there could be innovation in terms of your go-to-market strategy, innovation in terms of the way you have the product mix that you have, your evolving product mix. Anything can be, innovation can play a big role. And of course, we do look at operating leverage situations, which are when you have you've undergone a huge capex cycle, or you've already created the capacity, and now the time has come to really sweat those capacities out. we look at large addressable markets. Businesses also should, and entrepreneurs should also look at what and try and size the market for themselves. So we do look at markets that are large in size and typically prefer few players in the market. So all our companies where we invest in, you will have two, three, four, five players, which have the major market share, not more than that. I mean, five is, most of our companies are duopolies or three players or four players. A very important parameter that for us, when we have seen all, in successful companies which have created huge value in the market, is that they like to grow, they like to have a healthy growth rate, but they don't want a mindless chasing of growth. And that often leads to all the problems that companies face, mindless chasing of growth,
Right.
needless diversification. Your initial success leads to you going out of your core business, diversifying, using company surplus funds to buy, non-productive assets like land and real estate, so that when the time comes when you need those resources, they are all illiquid, and you are stuck into illiquid assets. So a lot of these things we've seen. The debt aversion, debt is a bad word for us when we select stocks. Now, I'm not saying that MSMEs don't need to borrow, but what we have seen is that companies which started as MSMEs and grew to, which started as small companies and grew to mid market, mid caps, and then grew to large caps. They also, when they started, they took some amount of debt, but entrepreneurs were very conscious that debt is a means to an end, not an end by itself. So you take the debt to reach a certain point where you start generating sufficient cash, or start raising equity and prune the debt to very, very manageable levels, or make it zero. Most companies who have made it zero have seen huge growth going forward in business, as well as market cap rewards have come to the investors in those companies. Very important point for us is free cash generation. Now, oftentimes, and this is where I have actually, in my private equity days, I used to counsel a lot of MSME entrepreneurs that, profits don't mean cash. You may have profits on paper, but all your profits may be logged in your inventory or in your receivables, or and that means you are not you're generating profits, but those profits will never be used to pay you dividends, or so you cannot or reinvest those profits in future growth. So you need to then go to a bank, borrow more to grow more, expand your balance sheet to grow more. So what free cash generation is very important. You should be able to have your working capital cycle in check, so that the profits actually sit in the bank. So control that working capital cycle is very, and that's very, very important for us. We obviously love companies who pay a healthy rate of income tax,
Right.
because that means that the profits are real. Of course, we want to see companies which are high on the environmental, social, and governance quotient. Where for example, if we have invested in pharmaceutical or chemical companies, then we do look at what kind of an environmental strategy they have for meeting all the environmental zero discharge norms. When we have invested in companies which are in the textile value chain, and where large number of people are employed, and we feel more comfortable with a more inclusive environment for your workers. So it's industrial relations and productivity. Everything is linked to what kind of environment you create for your workforce, and of course, governance, corporate governance, transparency. Good accounting practices, or respecting the minority shareholders are of course very, very important. That is basic check the box for us. So this is what I thought I wanted to share with you in terms of the. I'm just going to
Yeah.
unshare this, and then we
Yeah.
can continue with our chat.
Yeah, Sandeep, this was a great one-pager to do or not to do toolkit for MSME owners and managers. And if all of you are watching, and please do take a snapshot of this and keep it as a sticker on your door. I think this is a good, simple 8 set or 9 set pointer as what to do on a day in and day out basis. I was
Uh,
particularly happy to see point number 7 and 8, paying income tax and ESG. I think not many people feel that's key, but I think as we go forward, I see them as adding to governance, and government will give you the value kicker that 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 you want to see in a company going forward, regardless of its side. And yes, from the MSME side, I know that MSMEs are very averse to taking debt and leveraging debt because उनका mind में है कि कर्जा नहीं लेना है. So, and to service the debt and leave it for the next generation or for the people coming
no,
after
it's
them.
a
So generally,
sort
I find it, I mean, that they are reluctant to take debt, but there are people I know who do access debt and are also leveraged. And so there's nothing you can do about that either.
Yeah, so debt taken in moderate in moderate quantity, if you go and opt for debt and with a very clear plan that as to how I'm going to repay the debt, not make it a perpetual debt, that is
Right,
that is not a problem. Problem is when in the pursuit of growth, people forget the balance sheet side. Banks, there are cycles. There are cycles where banks become very liberal lenders. So you think that this is free money coming to me. Why not I use it? And at that point, if you lose your sight on your own working capital cycle, you're not generating free cash. You are actually taking unprofitable contracts. EPC companies, for example, they went through a cycle where they built an order book of loss-making contracts. So that is something which we avoid. We don't want to see. We don't invest in those kind of companies.
yeah, that's interesting. So good set of pointers there for all of us. Just to take it on a different angle now, Sandeep, let's just go to the retail market for a moment. That as you know, interest rates are falling, and interest rate on FDs and savings are coming down. Fixed asset incomes are also showing some kind of flux and downward pressure. But in the COVID period, as we all know, 3 or 4 million new retail investors have come onto the market, and they are playing in the day market and more in the cash segment part. So that's given the market more liquidity and probably broadened a bit. Going forward, do you see this addition of these 4 or 5 million new retail investors, day traders, or maybe mom and pop people sitting at home and playing the stock market? Will that allow the markets to be more steady and give it a broad-based equilibrium rather than constant oscillation, because the number of market makers are fewer now as the number of investors are more wider, and therefore no one set of uh, players can really dictate which way the market should go? Will it dampen the oscillations, or do you feel that it will continue to follow a certain historical trend?
See the new set of investors, retail investors who've come. Uh, you know, Obviously there was a lockdown. Now there are these platforms, very very tech-led platforms, stock broking platforms, which allowed you to open an account on the fly and then trade. So that provided a lot of, I would say, liquidity in terms of trading, and that will that continue at the same pace? I'm not sure.
Okay.
However, what it has done is it has actually the good part of that is that people have looked at equity investing as an avenue from the hinterland India. I mean, this was not just an urban phenomenon.
Right.
And now you need to go back to 4 years when there was demonetization that happened just four years and a few days ago. What we can keep debating demonetization was good or bad. I'm not debating that. I'm saying one good thing that has happened post demonetization is that the need for people's thinking about holding cash versus paying taxes and investing that cash in financial assets has gone up.
Right.
And this phenomena of retail investors adding is only going to give a more fillip to
Right.
financialization of savings. and
Okay.
that bodes well. So what I feel is that, and that's also, by the way, mutual funds. If you see the growth rate in SIP investments, the non-urban growth rate is higher than the urban growth rate. So what we are seeing is that, and we are still under penetrated as far as equity investments are concerned, even mutual fund investments are concerned. So my feeling is that we are going to see, the good thing with this retail investors coming is that the culture of equity investing is going to further deepen, and that is what will provide perhaps more stability to the market than the short-term swings that day traders kind of do. So yes and no. Yes, this is
So,
in the long run, it will definitely bring more stability in terms of the gyrations that the markets see, but not on this count only. I mean, there are other factors also
so,
which can provide, give more breadth and depth to the market.
absolutely. No, I think the where I was coming from is that obviously and we all the other people here would be aware of is that the FIIs often dictate the state of the market, whether it's going up or when it's seller, net buyer. I noticed that even if they are net sellers, there enough domestic demand to take the market on and to the next level. That shows, as you rightly said, and it validates what I've been thinking, that the financialization of savings is taking place. Hopefully,
Absolutely.
through SIPs and more mutual funds, there's a more steady state financialization and not a day trading transactionally type, and that I think should be healthy for the Indian markets going forward. That
So
so kind of that's what I thought.
right. There's one more point which we can add to this thought is that, see, even HNI money, which in the earlier years used to be finding a lot of equity investments were direct. Now there is a lot of sophistication that is coming in the management of HNI money, and it is flowing via AIFs and PMSs. Now that also brings a lot of sanity to the market, because once you have once you do asset allocation and then it gets further invested by professional managers. So to that extent, again, it is not, there is an additional layer of diligence, an additional layer of understanding which is happening, and that kind of, again, exactly what you are saying, the financialization of savings, and especially when it comes to small and mid caps, I think these HNI money also flowing into AIFs, PMSs is also helping
Hmm.
discover value in the small and mid cap space.
So
And I don't
let's
think that is short term money.
so we have discussed the retail mindset and the retail uh, retail mutual fund player. Now let's put this scenario in our mind that I am an MSME CFO and
Hmm.
I look after treasury. I have, as you rightly said, I have free cash flow. I'm not getting a good return, leaving it in current account. Maybe FDs. I might park something there. Now, for a MSME treasury guy with free cash flow, or he's raised capital and he wants to deploy it for 12 months, 24 months. Do you feel a PMS, a small mid cap focus, would help this MSME CFO get some return? Because by nature, I'm assuming this guy would be risk averse, have high expectations, and have high need for liquidity. So, is there a threshold where he can play with, where he can look at some segments of the market, say mid and small, and within that cherry pick certain stocks or portfolios where he can expect decent return, better than what his banker is giving him, or he's getting it from other assets which are he has deployed? Is this a possible toolkit for an MSME CFO?
Sure. So we have a few such clients where MSMEs who generate cash on a regular basis. They are our clients. So here the question is, first fundamental question is that, does the company or the business that is generating cash, does it require cash back in the short term? If answer to that is yes, please don't invest in small and mid caps. However, if you are a cash generating machine where you keep generating cash, maybe the amount changes a little bit, but every month there is a free cash that gets
Yeah.
generated, and you have that and of course you are not public, so you're not you don't have to market, and you don't have to face public scrutiny every day from analysts and why are you doing this. Then you are a closed-ended private company, and you can think of investing with that, with a 5-year window, because returns cannot be predicted in the short term. But over the long term, yes, there is a significant alpha generation potential that small and mid caps offer.
So I'm going to send you an invoice for this tip or advice if you're already not practicing it. But I'm sure you guys are very much aware that MSME is a big bucket, and I'm sure if you mine it, and you will probably get enough people there who will be able to satisfy those conditions. Um,
Absolutely.
so Sandeep, now we have discussed the market side, and you do run the PMS. Now let's see you putting on a different hat, and your firm, Nine Rivers Capital, is also some kind of a boutique investment banking firm. And just for everybody's understanding, an investment banking firm helps companies raise funds, helps them look at mergers, helps them with acquisitions, helps them with their strategy for growth. So, as a boutique iBanker, and I know that you have had some good deals under your belt, mainly for smaller companies and mid-sized companies. How do you see the market now for, say, a small company and a company which is in the growth stage? Is there an appetite amongst the investors to seek such companies, or the market is very tepid? Or you feel that the market is actually just about hungry for finding out more such players, either at the seed stage or at skip the seed stage straight to Series A stage?
Okay, so we have a boutique investment banking arm. So two separate legal entities, two different teams. I'm just the common link across both as a founder, and it's headed by my partner Vinay. I'll give you my, of course, thoughts on what's happening in the deal space. So, firstly, when the lockdown happened, first couple of months, there was absolutely a lull. There was not much activity. But after that, surprisingly, we've seen a lot of deal making happening. In fact, we ourselves, we've closed one fundraising deal from some reputed VCs. We've raised a Series A for a health tech company recently, where no physical meeting happened. All interactions between investors, and there is not one, but there are two investors. Interaction between investors and the founder was virtual. The due diligence was entirely virtual, no due diligence agency, because there are two different cities involved. And in the end, all the documentation and the legal closing was also virtual. So yes, the deal making on the fundraising side has been very brisk. We are having our hands full with engagements right now for various Series A and Series B transactions. What kind of companies and what stage of funding? So my sense is that today, the seed stage funding ecosystem is also quite, I would say that it's quite evolved from what it was a few years ago. There are quite a few seed stage funds that are there. While our focus is that we look at Series A onward, Series A and Series B fundraisers, but seed stage fundraising ecosystem is also quite becoming vibrant every passing year. Companies typically who get funding are companies who so there is a tech space, there is a consumer space, there is a healthcare space. These are the three sectors where VCs participate a lot. The more traditional sectors like industrials or infrastructure or pharmaceuticals, it's a private equity funds, the larger private equity funds, they look at those kind of opportunities. Financials, where it is fintech, it is VCs, but where it is more mature financial companies, it goes into the private equity domain. interest in these sectors is very much there, but what is happening is people now look for a certain level of progress in terms of on the business side. Just a
Right.
tech platform is not sufficient. You need to have a few clients. You need to have some amount of your economic metrics of your business, and have it should be in place at least to demonstrate that if I get the money, then this is what is going to be the economic metric, and therefore I'll have unit level economics which will allow me to grow the business and not consume infinite capital. So those are the things that we see more and more investors are asking. Whether a company should go to a seed stage or Series A directly also depends on the nature of the business, and how much capital it needs before it can show the scale. We've seen both kinds. So we have mandates where seed stage funding has been raised, and there are ones where actually we are doing a Series B for a company where there is actually a very tiny amount of money that was raised in seed, and then there was no Series A. So it's very case specific, Probir. I'm sure you would have also come across many companies where it's there are, see, in the consumer space, for instance, direct to consumer companies, we've seen that the need to go, there is a need for a seed stage because initially the customer acquisition costs are very high, so you need to build the platform and go there, and then you need to go to a Series A. But we've seen companies in the SaaS space which was built on a bootstrap basis and going straight for Series A. So I would say that it's a case specific situation here.
Yeah. No, I think that's interesting that you're quite optimistic and positive on uh, capital looking for good companies. In fact, I've been looking at a couple of acquisitions over the last few years, or rather overseeing them in the space of probably gaming, IoT, and fintech, probably about a dozen or so acquisitions. And I was just wondering that whether post-COVID, the metrics by which a management decides to go out for a fundraise or an acquisition or a merger, have those metrics changed or the rules of the games changed? Or is it still triggered by financial metrics or vanity metrics or just fear of missing out metrics or none of these?
Uh, so, the fear of missing out, I'll start with the last first. I can clearly see in the large PE funds, buyout funds, every one of them wanting to buy a pharmaceutical company, API manufacturing company. You would have already read of some of the trailblazer deals that have happened, and we have inquiries from, the other ones who are still not done. So it's it's driving people to crazy valuations, so to say. So that's the. But in general, I think post COVID, what we've seen is that while financial metrics are still looked at and are important, but one is not looking at the immediate future to apply those financial metrics because of the uncertainty around when the normalcy will return. There is you were hit in the past. So take for instance, we did a deal in the co-living space some time ago. About now, co-living space was directly hit by the lockdown. Every co-living company, the large or the small, every co-living company has been directly hit. When we are talking now for the, for two investors, all of them are willing to discount the current time as an unusual time,
Right.
as a force majeure, and they are not at all, not at all feeling nervous about this space. In fact, they are quite upbeat that once the normalcy comes back, young population starts going to work or people start going to colleges, then again it's the same. The weaker players or the unorganized sector which used to serve, that will actually be up for grabs by the organized people who are better capitalized and who have a better platform and giving that better experience to the people who come and stay. So this is what we are seeing across the board. Financial metric is important from a standpoint as to what you want to do in future. Now you have to be obviously a little more frugal when you are going to go and roll out your growth plan. So those aspects are being looked at, but it's not purely you have been done and dusted during these times, so you will not be funded.
Right.
That's
Okay.
not the case. Yeah.
Okay.
Tech companies, SaaS companies are in
Sure.
demand. Enterprise SaaS, big time. People are very very keen to look at. So as I said, D2C. So I would say there is a lot of reasonability, but not except for this pharma. I haven't seen FOMO in any other sector.
I see.
Pharma, yes, pharma, and that
Okay.
to large buyouts, controlled
Right.
transactions.
Right. Now, before I open up for that, you can ask me some question because it should not be a one-way firing. I'm just wondering, as a follow-on to that, in the MSME sector, Sandeep, which are some of the sectors which you are upbeat on going forward, without mentioning names of the companies, but perhaps if you identify like non-pharmacology or logistics or manufacturing, is there some sectors that you're particularly keen on looking out for because you see that mechanical rebound really picking up, and then they grow from here on?
So absolutely, there are clearly going to be some sectors which are going to, at least over the next 3 to 5 years, see a huge growth opportunity. They are on the verge of capitalizing on a huge growth opportunity. For me, healthcare is one sector. I'll give you some rationale also for that. One is that when the COVID breakout happened, the whole world realized that they are underinvested in healthcare. So leave aside a country like India, which was hugely underinvested, but even Europe and US. So
Yeah.
what is very likely is over the next 3 to 5 years, the healthcare budgets in this country to build the healthcare infrastructure will allow or will offer Indian companies a lot of opportunity. And healthcare is not just pharma. I'm talking about the whole healthcare value chain,
Oh,
medical devices to building of hospitals to what, so the hospitals have specialized equipment, machines, and Indian companies can play a role in this whole revitalization of the global healthcare infrastructure. Even in India, the Jan Arogya insurance scheme, which the government has rolled out for the masses, where if
yeah.
you get a 5 lakhs insurance cover, will allow these healthcare companies and pharma companies to grow because people who would otherwise not go to a hospital for treatment of will now have that ability to do that. And that means that if you can provide reasonable at a reasonable price drugs or medical consumables, all this is a big growth opportunity even domestically. So that's one sector which we clearly I would say that will one should look at very seriously. One should look at the rural businesses connected to the rural economy, agri, because these recently the government has passed some agri reform bills, for direct market access to farmers. What that does is that actually leaves a lot more disposable income in the hands of smaller farmers and smaller aggregators of farming goods, which ultimately has a much bigger multiplier effect when they go and spend. So rural economy, staple consumption of staple goods, agri related businesses, they are all, I think, very good investment opportunities going forward. We are investing heavily in upgrading our defense infrastructure technologically. So and of course space is also growing as much. So companies focused on aerospace and defense, they are so that is a good sector to look at. Again, pharmaceuticals, for the same reason, it's a part of healthcare. So pharmaceuticals one should look at. for Indian companies, engineered goods, they can be as a China plus one. We will be very, very good at engineered goods, be it automotive or otherwise. So definitely, I would look at engineering and manufacturing companies that serve the automotive sector and other sectors. Worldwide, it's an opportunity for them to become a China plus one, supplier. So that's another sector that we look at. And we spoke of financialization of savings. So
Sure.
that is one sector which, from time to time, it becomes very attractive. So valuations from the peaks have fallen off now for good quality, good banks, and good some of the NBFCs also will become very good opportunities for a long-term investor. So I mean, India will grow. Any consumption play, because we are a country which will continue to grow. So, consumer goods, whether it is fast-moving FMCGs or consumer durables, from
Sure.
time to time, there are times when you will have those opportunities to participate in those companies and look at consumption trends. And if you can pick up a changing trend and invest early on, go back 20 years, guys who invested in Pidilite, go back 10 years, guys who invested in Astral Poly, which was basically making a CPVC pipe that goes into behind the walls. You can't even see that, but you branded that. When you go
Yeah.
to
Yeah.
your plumber says buy a Astral pipe, not a CPVC pipe.
Yeah.
The carpenter used to tell us, not don't buy an adhesive, buy Fevicol. So look at companies who can basically become synonymous to their brand becomes synonymous to the product, and they will keep coming from time to time, and you will have those opportunities in India. It's a large consuming country.
Yeah. No, I'm glad you mentioned, no, I would call it the intermediate sector companies or economy, the pipes and the sealing adhesives and the fasteners, etc. That demand will also go up. Over and above, what you also meant is, the electronic economy, the B2B payments, the gaming, the over the air entertainment,
Absolutely.
all this is video conferencing and other
Yeah, this
electronic
is
aids.
this is
That
consumer
goes,
behavior change.
yeah, that
This is
goes
consumer
without saying.
behavior change. Yeah, yeah,
Yeah,
yeah,
that
absolutely.
goes without. No, we are seeing behavioral change at the consumer level, but also I feel at the corporate and enterprise level, they also realize that they want to do things more efficiently, perhaps more digitally, end to end. So they are adapting on their own, pulling. The pull is coming from corporates for onboarding payments and enterprise payments uh,
Right.
and productivity efficiency tools and platforms. So
Right.
with this,
So
Sandeep, if you have any questions, please
So
feel free.
here is my question for you. It actually comes from the payments and the. So what me and my colleagues often have discussed this internally, that it's only a matter of time where fintech on the one side and big tech from the other side are going to disrupt a traditional bank. And a traditional bank makes a lot of money of its customers today, but with the whether they will be in a position to defend those margins and those the money that it makes, whether it's by way of fees or transaction charges. Today I buy Amazon Pay. I load an Amazon Pay and I can virtually do everything on the one side, and on the
Right.
other side there are a host of fintechs which are offering me something similar on the transaction making side. So first of all, do you believe that they are going to come and disrupt a traditional bank, and which means that banks, the valuation parameters of bank going 5 years from now needs to be devalued? And two, if you do believe, then what is the timeline?
See, frankly, Sandeep, I've been hearing that this for quite a long time that the banks will get disrupted and disintermediated. And I've been hearing this for the last 10 years. Obviously, that's not happened. Banks have adapted digital to survive. So the incumbents have decided to adapt and pivot to adopt the digital challenge and bring it inside the house with their partners so that they can leverage that rather than be totally disrupted and disintermediated where the payment companies become a neobank or a pseudo bank or maybe a full-fledged wholesale bank. at some point. So that's one school of thought. The other school of thought is that many tech companies who provide core banking solutions for global banks are feeling that now why can't they just apply for a banking license and become a bank, because anyway they understand the processes and the systems and the technology behind it, and they're anyway providing it. So if they can do that, and this has happened in Germany where one of the large IT companies applied for a banking license. So I think in India, Nachiket More's report had given a concept of differentiated banking or license on tap. So he saw a roadmap that you could come in as a, as a wallet provider, a PPI, and then move to a payment bank, to a small finance bank, to a newer bank, and at some point maybe NBFC before that, and finally a wholesale bank. Now, when that entire journey happens, and if it happens, one can't really predict, but there are no good use cases. Frankly speaking, there was a big tide in favor of neobanking in Europe, but unfortunately, that's not panned out as it was supposed to be envisaged. So they've belied the expectations. So I think they've parked the transition of a tech company or a payments company trying to make the journey to banking. So I think banking will continue, but banks and fintech companies will be partners, I think, more so. And they will either be
Okay.
bolt-on partners or actually co-partners. So that they continue to garner the leverage of working with specialized guys with their traditional banking business. Having said that, the whole concept of non-banking bank is only if you can crack the transaction fee model. So out of
Yes.
100 bits, if you can get 75-80% based on transaction fees, then you're a viable model. But
Right.
currently, you're depending on NIM. So NIM and then transaction fees is just a nice topping off. So, but it has to be the core of the business. Instead of
Right.
25% transaction fees, you should say payment banks or payment related businesses have 70-80% core revenue driver as transaction fees. Then that transition will happen and the economics will support a neo bank or a quasi or a pseudo bank, rather than just following the bank's bad practices and asking the payment company to follow the same practice, because they can't manage that risk, and it won't be
Absolutely.
viable. It won't be viable for them. So they won't make that
Absolutely.
transition. They won't make the transition. So I would say be cautious, but if you can crack something, be a payments bank, see that most of your income is from that. And if you want to play banking, then tie up with a regular bank to cut a loan, cut credit, cut overdraft, right? Don't
Right.
take it on your book, take it on his book, and you just be the intermediary who's onboarding a customer for the bank, and you take a certain basis points off the top on the total transaction value or commission or the fees. That's how I
Right.
see it.
Right. No, so just an add-on to that, Provi. But what about the big tech, the Googles and the Amazons of the world? They have the balance sheet power to disrupt. I mean, can they do something different?
Yeah, technically, you're right when I said that tech companies feel that why can't they apply for a banking license in some jurisdiction? Then you're right. Apple has a big uh, chest of money. Google has, Facebook, all have. It's a tough call. I mean, as a digital guys would be saying, are we good at that? Do we have core competency to get into those areas? And that call,
Right.
I think, will be taken, probably in due course. Nothing is stopping them, mind you. As you rightly said, nothing is stopping them. They will be well capitalized. They will have very good capital adequacy ratios. They might bring the best bankers on board. But whether they will be
Absolutely.
successful in that business as versus successful in another digital business is a call that the founders would need to see whether they have the DNA for or the mindset for. I suspect that that verdict is still a little far down the road. Though I could be
Okay.
wrong. I could be absolutely wrong. And so
No,
one is
no,
not
no.
sure.
So you are right. So far, it's not happened, but it keeps getting discussed, and they are slowly entering into owning the customer more and more. So today, I'm just as an example through Amazon. I can buy I mean, I can buy insurance tomorrow. I'll be able to buy mutual fund. I can do everything that a bank offers me to do. So we have been thinking, when will this gap get bridged? No,
Yeah.
thank you for your perspective. This is helpful.
Thanks a lot, Sandeep. Great discussion with you. And I'd like to hand over back to Megha if there are any questions from the audience and the participants.
Yeah, sir. Yeah, I'm waiting. I'm looking into it. I would like to request all the participants if there is any question from them, or they can write in the inbox also.
Okay, I will ask some questions.
Okay, sir.
Okay,
Fine, fine.
first I just appreciate your discussion. You have already given great insight into this subject, and you have also taught us what would be the future of the this banking system and all. So that as I represent MSME sector, what would be the rebooting strategy? How they can redesign their business to sustain in this means post-COVID?
So, Dr. Lai, I feel that there are going to be a lot of opportunities that will emerge for MSMEs in the post-COVID world, as I said, because one of the biggest drivers that I see for reviving the MSME sector can come from companies looking at China plus one, global companies looking at China plus one sourcing coming to India. It's going to take a little time because we are still in COVID times. There are travel restrictions. You can only do so much virtually, over video calls. But once this COVID dust settles down, there is a lot of opportunities that will come in terms of global companies coming in and looking at either setting up their own shops here or doing a JV. And then MSMEs are obviously a part of the supply chain. So if today there are companies who are, let's say, working with an automotive OEM, they should definitely go and liaise with those OEMs and say as to what else can we do for you. Because the needs of our exports and the needs for of foreign buyers will be slightly different than what you have been doing currently. Second is that you look at, as I was explaining through my slide, look at some of the policy tailwinds which are available to you because of not just the financial subsidy part of it. It is more about where I'll give you an example. For example, the need to increase blending in the Indian fuel from 5% to 10% so that your vehicle emission gets reduced requires companies to double the ethanol capacity. I mean, sugar companies to double their ethanol capacity, because earlier the blending requirement was 5%, which is now which has now been taken to 10%. Now you can't do this overnight. You need ethanol making capacity. Now ethanol making capacity requires ethanol plants. Ethanol plants require so many parts. So it's a question of look at my guidance would be look at the tailwinds which are available to the economy as a business or as a policy. Look at changing consumer trends and decide what you can do in your own business which can be more value added. Focus on value addition. Don't focus on revenue alone. It is the value addition which will ultimately allow you to come out of the phase that you are today. Second, my advice to SME entrepreneurs would be, don't be averse to taking on board an equity partner. Equity partner could be some HNIs, or if you are of a certain scale and size, equity partner could be even a fund, a private equity or a venture capital fund. Third aspect, Dr. Layak, would be, and this is something which I have advised to a lot of entrepreneurs in the past, that getting out of business is also not a bad option. Suppose you are suboptimal in scale and size, you may want to say that, okay, let me get out and let me, get into a new business. So don't be so emotionally attached to your business that you say, this is so my generational business and I can't sell. Uh, Become a little dispassionate about and be realistic about your business. Many times, you may have somebody on your door ready to buy a business and pay you some, pay you for the goodwill of your business, pay you a premium for it. No harm in cashing out and then rebuilding a new business from the scratch, or going and acquiring a new business which you feel is right business, given your given your management bandwidth and your expertise. So this is what my advice to MSMEs would be. See, this is, as I was saying earlier in the talk, that it's a samudra manthan going on where everything will come out. So some people will have to suffer also, and some people will benefit. So the people who are likely to suffer, they will have to rethink and take a rebirth. So this is something which entrepreneurs should be very realistic at this point in time as to
Right.
how to deal with situations, especially those who are facing challenges.
Thanks.
Any other questions from anyone? I don't think, sir, we have any questions now because no participants is writing any question. So we can move towards the vote of thanks, sir.
Yes,
Yes,
please,
yes.
Megha, please. Thank you.
Yes, sir. Thank you, sir.
Thank you.
I, on behalf of World Association for Small and Medium Enterprises, it's a great honor to propose the vote of thanks to all guest speakers, participants, and WASME team. I would like to thank our distinguished speaker, Mr. Sandeep Daga sir, for making excellent presentation and making this webinar interesting and meaningful. I would like to express our profound gratitude to Mr. Prabir Roy for his presence in this webinar. I would also like to thank our Dr. G.P. Agarwal, Secretary General WASME, and Dr. Sanjeev Black, Executive Secretary WASME, for his support and guidance. Once again, thank you all of you for making this webinar successful with your contribution. Thank you, sir. Thank you so much. And I
Thank
would like
you.
to request all the participants kindly copy that link of the feedback form from the inbox.
Thank you, sir. Thank you.
Thank you. Thank you,
Wonderful.
Thank you all of
everybody.
you.
It
Thanks
was
a lot.
nice.
Thanks
Thank
for
you.
your time.
Thank you. Bye bye.
Thank you very much. Bye. Thanks,
Yeah.
Megha.
Thank you,